Welcome to Leaders in Lending. I'm your host, Jeff Keltner. This week's episode features my conversation with David Houchen, the CFO of First Federal Bank of Kansas City. I thought this was a really interesting conversation, not least because FFBKC is a slightly unique bank. They're much more consumer focused with both a localized Kansas City footprint as well as a national program for mortgages. They also have been traditionally very mortgage heavy shop, but are looking at new kinds of products. So lots of interesting discussion around the strategy behind those different decisions. We also dove into the shift to hybrid work, how they were ready for it, what they're doing to adapt to it. I think they've actually been very forward looking at how they adapt to this kind of changing environment. And it's really interesting to hear their perspective on both kind of what comes next for them after the refi boom and the mortgage place, but also what comes next for them from an internal perspective on how they think about engaging in work and shifting physical plants and culture in a world of hybrid and remote work. So really interesting conversation, great perspectives. Please enjoy this conversation with David. David, welcome to the podcast. Thanks for making the time to join us here.
Thanks. It's an honor to join you.
I don't know about honor, but we'll take it. We'll take it. So I've been starting off all my conversations now with the same general question, which is, most of us didn't grow up dreaming about being bankers. What was the path that led you to this place? How did you wind up in the banking industry?
Yeah, like most, it's been with a few trials and tribulations along the way and different paths that we didn't expect. But in college, I studied accounting, finance, and got an MBA right after. So that part
More
was pretty
straight
traditional.
path than most I hear. It's accounting, finance.
Yeah. So then I worked for a regional CPA firm for about 10 years, which was great experience. Then I went to work for one of my financial audit clients, which was an international nonprofit organization, where I was in leadership for about 18 years. So that was a pretty neat experience where I got to travel to Central and South America, Asia, different parts of Africa, and just kind of saw some sites that were not on the normal tourist path. So really enjoyed that. That kind of ran its course. Worked for at a private university a couple of years as a CFO, and then one of my friends from public accounting asked me if I'd like to become CFO of his bank. So I said, if you don't mind, starting from the standpoint of not knowing anything about banking, sure, I'd love to visit with you about that. So he for some reason hired me and kind of went through a fairly fast track on the job training program. So been in banking about 5 years now. So I feel like the learning curve some days is still fairly steep, but I'm really enjoying
That's interesting. That's quite a transition from the travel and in the nonprofit side back into the banking. Was that a culture shock for you? What was that kind of transition like?
I found I had more hours in my day when I was spending less time in airports, but I really enjoyed that part of my life. Like I said, I got to see some cool things and meet some neat people that I would otherwise not have met and learned a lot about some other cultures, and really gained an appreciation for how appreciative that most folks in other countries are for Americans, and how generous overall Americans are and willing to help that we are in other places. So anyway, I was just part of that world for a long time, and that was really a lot of fun. But with getting a little bit older and travel after 9/11 becoming not as fun as it used to be, I'm quite happy now to spend less time in airports and more time around the U.S.
Yeah, understandable. It's hard to remember what travel was like pre 9/11. I meet so many people now who never really experienced it. The younger generation that has never they've always had the TSA and the shoes and the whatever.
Yeah. Careful, we're devolving into old guy stories now, so we might not want to do that.
Yeah. So I'm gonna flip it up then. And that's so FFBKC, interesting thing for you guys, I think, is that you're a very consumer oriented bank, where I find most institutions are maybe more commercial focused, or at least 50% of their focus is really in the commercial space. And you guys are a little bit more consumer oriented in your approach. Tell me a little bit about the history of that and how you think about being, a little bit more consumer oriented in your overall strategic approach versus the traditional banking, style.
Yeah. There's probably around 10,000 banks and credit unions in the
Mhm.
United States, and they each have a somewhat different story, as to how they
They all
got to
do.
be where they are, and why each of us do what we do, and that kind of thing. So, uh, First Federal Bank of Kansas City was formed in 1934 as a savings and loan, basically. So
Mm.
we've been focused on really the housing lending for the vast majority. Well, we still are focused on that area, but it was exclusive for a long time.
Mhm.
So that's just been a natural focus for us. We've added through the years more types of other types of consumer loans besides home loans. But um, we don't do any commercial lending. We don't do any ag lending. So some loans to home builders is about as far off the beaten path as
Far off the
we
beaten.
as we get. But another unique aspect of First Federal is that we're a mutual bank, meaning we're owned by our depositors. So
Mm.
so it just, I think it leads to some different maybe some differing values at times and different decision making as compared to either publicly traded banks or privately held banks that are maybe
Mhm.
more focused, at least at times, on shareholder issues and maximizing stock value and so forth, where we try to be more focused on what's best for our customers, for our depositors who ultimately own the bank at the end of the day.
Yeah, it is. Your story always reminds me somewhat of the credit unions as much as the banks, and that kind of focus on the consumer side and that kind of cooperative nature. But it seems like it's working for you to some extent, Dave, because you were telling me when we chatted before we recorded this that you guys have a pretty high loan to deposit ratio, which is not like the common narrative I hear these days is like deposits up, loan demand down. Help me fill the balance sheet with stuff that can put these deposits to work. And you guys are not really in that position per se, which was really interesting. So tell me a little bit about where you guys are at from that perspective.
Yeah, so we seem to specialize in being different than the mainstream financial institution. So I guess this is another area. So I mean, like many financial institutions, we were pretty flush with cash for the first year, especially of
For sure.
COVID through mid 2021, and because we had so many home loan customers, many of those folks were refinancing their mortgages, understandably, which was a smart thing to do, and um, led to a lot of. We had a great year in 2020 because of all the refinance activity,
Mm.
but a downside of that was many of the home loans that were on our books refinanced, and because of the dynamics of the market at that time, we were selling most of those loans after we refinanced them. We retained the servicing of them, but we actually sold the loan. So our the loan side of our balance sheet got a little bit depleted during that 2020 and early 21 time. So we, over the past year, focused on rebuilding the asset side of our balance sheet. We've put more home loans in portfolio and have retained those. We've built our investment balance up a little bit, and
Hmm.
we've worked with this neat company called Upstart to build our other types of our consumer loan portfolio, namely the unsecured consumer loan. So we've built that part of the portfolio really very aggressively over the past year and a half, and so
Hmm.
those are performing well and have helped to be a source of investment for our liquidity. So yeah, our loan to deposit ratio is about 110%, which is about as high as we like to get it. But it's for us to be efficient. That's also kind of where we like to operate.
Where you like to keep it, yeah.
The home loans are pretty safe and secure and all that, but the interest rates are not as great as some of the commercial and other types of loans. So we had to stay fairly fully leveraged to be profitable with a high percentage of home loans.
So was that part of the shift? I mean, I'm curious your kind of focus. You talked about personal loans with Upstart, and I always try not to make this too deep on the Upstart partnerships, but tell me a little bit about the kind of the types of loans you are interested in, are putting on the books outside of the home loans. I think it's an interesting, question of like if we want to get outside of that, where and why I mean, I think there's the natural, like, is there demand that we don't have, particularly as refi probably slows down, and that's likely a secular trend for a while with where interest rates look to be going. The refi will be slower, and then the margin difference for a less secured product, obviously a home loan being one of the most secured kind of loan types you can give out to a consumer, it's the margins are naturally thinner. So, what's your kind of calculus on the kinds of loans and the way you evaluate products that you might want to put into the mix?
Yeah, so we've really in the last 3 years been focused on, to some extent, diversifying our loan asset mix. So we always want home loans to be the core of what we do, and again, that's part of our 90-year heritage. But the as you referenced, the kind of economic cycle for those ebbs and flows, and so like 2020 was great, but this year and the last 6 to 9 months, just not so great. Just everyone who wanted to refinance their mortgage already did, and there's good purchase mortgage activity, but a lot of extra capacity. So we're looking to develop other types of loans, such as home equity loans, such as auto loans, such as the unsecured loans where we done primarily through Upstart, where we need more, a higher rate of return, basically,
Yeah.
To help smooth out the mortgage cycles that they look. If you look at our income, gross income, and net income on a graph, historically, it looks like a roller coaster. So it just cycles up and down. So what we're really focused on currently is just making that valley that's coming up to be not so deep, and to kind of round that off with the other types of consumer loans that do carry a little more credit risk, but it's manageable. We have a pretty strong credit culture within the bank, so
Mm.
we don't even the unsecured loans we don't hold the riskiest of the unsecured loans. We tend to be fairly selective in the borrower characteristics of the loans,
Hmm.
even unsecured loans that we do retain. So we think there's a very comfortable and profitable and manageable middle ground there, to where we can have a more diversified um, loan mix, and remain profitable, and not have credit issues that surprise us.
I did want to ask one more question on this topic. It was, how do you think about picking the way to go to market, particularly in the context of new products, a somewhat conservative risk culture that's, strong opinions on credit appetite. How do you think about bringing new products to market? I mean, I know you obviously did a partnership with us on the personal loan side, but are there, you know, contexts or considerations you have that are kind of, how do I go from thinking, hey, something other than mortgage would be a good counterbalance, maybe a higher yield, something to kind of fill in that trough in the down years, to how you actually put those products in market?
Yeah. So historically, like many banks, we're really not good at all at innovation. So we're starting to recognize that that's not a strength of ours. So especially on something we're going to do, we think has opportunity on a larger scale, we'll look for a partner. So Upstart has been a great partner with the unsecured loan program, and we're testing the waters on Upstart's auto program as well. But we've
Mm.
also got a couple of other products in the mix that we're going to develop internally, where we think we have a skill set to grow those, and we can grow them. We can start small with them, and kind of work through the growing pains, and hopefully develop some success there. So again, just trying to be diversified on that. We also added a person in the last couple of years, and kind of moved them to focus on innovation and technology. So that's another area that's been where we've probably lagged as a bank. I mean, the banking industry kind of has, community banks, I would say in general, tend to lag on the technology front, and we're no exception
Mm.
there. So trying to um, speed that process up a bit, hire some good people to focus on that. And again, I think for us and for most banks, the things we've done for the last 50 years are, in large parts, not going to help us necessarily be successful for the next 30 to 50 years. So we need, as a bank and as an industry, we need more innovation and more technology, and to stay better in tune to what services, especially the consumers, are desiring now, not what they wanted,
Not
15
what they
or
want.
20 years
Yeah.
ago.
So I wanted to dive into a little more depth into one part of your business that I thought was really interesting, which is on the mortgage side. In particular, you kind of have this interesting split between a geographic focus in the Kansas City area, which I used to live in Kansas City for a number of years, so I like Kansas City, I like my barbecue. Uh, I got my favorite spots in town, and then also a national focus, which are kind of like two very different, a nationally focused business and a kind of geographically constrained, almost a metropolitan area business. Tell me a little bit about how you think of those two businesses and managing between the two of them.
Yeah, so like most banks, we in our geographical footprint, which we generally our local geographical footprint, we define as the Kansas City MSA. So
Hmm.
we do your typical networking with local realtors and all those kind of things, maintaining those contacts, and so that's a market that we would like to have as high a market share in as we can.
Hmm.
That said, Kansas City, like probably many mid to large markets, has a lot of banking competition. So
Sure.
there's only so far that can go, but we want to own as much of that as we can, especially within the mortgage arena and the consumer arena.
Hmm.
But we also have capacity and capability to do loans across the country. So we invest in various lead sources and that kind of thing to source mortgage loans from around the country. The technology has gotten better there, so that those closings and so forth can happen largely electronically. We have beyond the loans we hold in our portfolio, we retain the servicing for many loans, so we
Mm.
retain the ability to contact those customers, and so hopefully they come back to us when they are ready to buy their next house, and those customers are across the country as well. So we want to maintain and grow those relationships as much as we can. And we also have the capability with that, which is something we're working to capitalize on, of developing deposit account arrangements with those mortgage customers in
Mm.
Kansas City and across the country. So that's an opportunity for us that we've had some success on, but again, with some technology investment that we're kind of in the midst of, it should help us to become more efficient at those efforts.
Hopefully, we can get some of those national mortgage customers to get personal loans and auto loans too. It seems like an opportunity as well. Do you think of that geographic diversity as an element of risk mitigation as well as just a diversification and a revenue opportunity to grab some share? Because it's one of those things that's interesting if you're very geographically oriented and particularly focused on mortgages, that you do have some concentration risk in terms of home prices and the local economy. Do you view any of that as a risk diversification, or is it mostly just a balance sheet? We want a little bit, we need more volume. We want to kind of find new channels.
Yeah, it's both. I mean, the volume is probably the higher priority for us, but
Mm.
the Midwest is generally doesn't get doesn't have quite the highs and lows that the coasts do. So we don't
Thanks for
worry
reminding
a super large amount about that. But yeah, it's nice to have the geographic diversification. So um, and we have pretty good reporting on what dollar amount of loans we have in what state and so forth. So
me.
we definitely monitor that. So it does provide some comfort to know we have customers across the country, and are not as dependent on one the success in any one geographic area.
Mm. Makes sense. And then the last area I really wanted to dive into is I know you guys have, I think every business has tried to think about what's our hybrid work approach. What's our, we all got kind of forced into this work from home. We experienced a version of work that was very different than the past and probably not like the future, but pointed us towards the opportunity for different ways of thinking about what an office culture, an office space what it meant to go to work and be at work and what that physical space needed to look like. What have you guys seen or done or shifted over the course of, the last 2 years as you've looked at the opportunities for new ways of working?
Yeah, so we've had some profound changes, at least for us in that area. Before COVID, we were preparing to test some work from home stuff. So we had some equipment and procedures in place, and we were going to have 2 or 3 people try it. And mid March of 2020 happened, and okay, let's have
Everybody
everybody
tries
try
it.
this and see what happens. So we did that, and it went surprisingly well. So and we've also been in a situation where we had office our administrative office space was in a kind of a light industrial part of town that
Mm,
used to have some retail connected to it, but really that retail has gone away. So we've been kind of putting up with our office location for some time, and the work from home success kind of pushed us to do something about that. So we put our building up for sale, and uh, did a search, found some office space in a different part of the city that's more retail oriented, and
hmm.
so have actually just within the last 2 weeks have moved to that location. But
That's
the new
exciting.
location is also about half the size as the old location, so not all of us can be there at the same time. So we are committing to a hybrid, work environment. So most of our
Mm,
employees will only be in the office 1 to 2 days a week, and will work from home the remainder of the time. So we've again had kind of 2 years to test this, and we feel like it's worked out really well for us. Our employees really appreciate the independence and focus that they can have when they are working from home. But we when we do come together, we remember how much richer those meetings and those conversations are when we can um, just be in the same room with one another and make eye contact and have the conversations that only happen when we're in person. So we're
it's a
thinking
different thing.
we can have the best of both worlds here, and as well as have some work lunch options that go beyond the McDonald's and Quick Trip that were the only two choices at our old place, and now we have multiple places we can walk to that are actually desirable eating locations.
That sounds like a nice shift. So, just one or two follow-ups on that. How have you thought about the any changes in kind of the built space, like how you actually design the office space for a world in which you're not? It's like when you're in there 5 days a week and you're doing all your focus work in that environment, you have a certain set of needs, and when you shift to a couple days a week and maybe more focus on the collaborative components that are so unique, does the way you design or think about the physical space and its amenities change?
Yeah, quite a bit. So we went from a office space that had a lot of walls and dividers and a lot of private offices to
Yeah.
the new space, which has a lot of windows, a lot of meeting rooms, and no assigned offices or workspaces. So you pack up when you
None.
leave, you pack
Wow.
up your stuff in a backpack, you take it with you, you work from home, then you come back the next day or whenever, and you unpack your backpack and find a spot. You got dual monitors at every location, and plug in, be sure, spend a couple minutes calibrating your monitors, being sure they're working like you want, and it's off to the races. So
And then you go.
completely different from that regard. All of us that had
Mhm.
offices and had, pictures hanging on the wall and so forth. Well, those are at the home office now. But yeah, we do spend a lot more time meeting. We when we're in the office, we tend to schedule meetings on those days, and um, have low, where there's the workstations, the um, cubicle walls are really short, and so just there's a lot of conversation and collaboration that happens when we're together in the office.
Yeah, there's certain things that are just better done in person, and I feel like if you can really optimize the office time around those, then that's a tremendous benefit when you can schedule the meetings on the office days, and then hopefully some of the days when you work from home are lower meeting days. That has not worked out for me yet. I still seem to have more meetings every day than seems ideal in the theoretical world, but that is what it is. Have you thought at all about how you think about maintaining culture? Those elements so often are unspoken and kind of taken in by osmosis in the context of the office, and now they need to be more in some ways explicit or intentional in terms of how you build a culture within the organization. I'm curious if as you've thought about this kind of new mode of work, if you've had any, thoughts or ideas around how you try and build or maintain culture in an environment where you're not next to each other every day.
Yeah, so that really is one of the tougher things to maintain and develop and so forth. The First Federal did a lot of work on culture, actually a couple years before I arrived, and had many meetings about it, and talked about what values and so forth are important to us, and really landed upon a set of values that I think are a good fit for the organization. And then in the past 6 months, we actually did a revision of those, and after we lived with the previous ones for a few years. So it's one of those things we just, when we talk among our executive leadership team, we talk about values on a regular basis, and so we count on those leaders to work with their groups and stay in touch with them on that level. One of the things we developed during COVID is our bank president communicates with all employees at least once a month via Zoom, and so culture and values and stories and so forth are an important part of those conversations and those communications. When we had really no ability for a period of time to be together and talk to one another, we realized even more so how important those things are. So anyway, it's kind of those goofy things. It's hard to talk about and have it make sense to anyone else, but it really is one of the most important things that we as leaders in any organization have to promote and keep top of mind.
Yeah, I feel like it's one of those things too it's hard as a leader in an organization to calibrate how often you need to be talking about such things, because while you might be in 10 of those conversations, each of them are with different sets of people who might only be having one or two of those, and so it can feel incredibly repetitive to the people telling and delivering some of those stories and examples. But it's like, it's not usually as repetitive to the general employee base as it feels to the leadership team that is talking about such topics. So it's I always find if you don't feel like you're talking about it too much, you're probably not talking about it enough.
Yeah, it's one of those things. It's kind of like whether it's culture or kind of the things that are important to the organization in the coming 1 or 2 years. It's almost impossible to talk about those things too much, even though most of us think, okay, we said it once, so let's everyone soak that in. It's good to go, and everyone remembers. But it really takes multiple times for our staff to think that, oh, well, I guess they really are serious about this, so maybe we need to jump in and help them go in that direction, whatever that direction is.
Help make those things a reality. Well, Dave, this has been a fascinating conversation. I think we've covered quite a bit of ground, actually. But I have kind of a traditional closing 3 questions that I ask everybody at the end of the podcast. So if you don't mind, I'm going to throw them at you now, and we'll wrap
Here we go. Yes.
Here we go. By the kind of rapid fire closing. Number 1 is what's the best piece of career advice you've ever gotten?
I think, and this is maybe even more for finance people, but it is to develop and maintain a network of business contacts, if you will, or friends that are outside the normal group you work with every day. So in larger organizations, that can mean just developing more contacts, I think, within your company, or in smaller companies, which I consider mine to be smaller, also having a group of whether it's friends, business contacts, or whatever outside of your bank or company. I've done that through an organization called Financial Executives International that that chapter is active in various cities, and have an active Kansas City chapter. So that's been a good resource for me over the past 10 years. I kind of neglected this area for some time myself, but anyway, it's nice when we're struggling with an issue or a whatever topic inside a company to be able to ask someone that's a peer that's working in a different environment. It's like, hey, how have you ever had to deal with this? And what have you done to kind of wrestle with this topic? So I found that to be very valuable.
Yeah, that's great advice. Number 2, what's the best advice you've gotten about the consumer banking or consumer lending space? This is a great one for you, since you've been here in the industry a shorter period of time. You might have some more immediate recollection of something somebody told you when you were coming into the space?
Well, as I tell our marketing managers and so forth internally, well, let's just make loans to people, to customers who will pay us back. So it's they kind of laugh at me, and I laugh at myself sometimes with that. But I do think there's a lot of underlying truth there that if we make loans in the beginning to the right people with the right characteristics and hopefully character, that they will at the end of the day pay us back, and we'll have fewer issues on the back end and with collections and repossessions
Yeah,
and
yeah.
all those kinds of things that none of us want to deal with.
Yeah, it's such great advice, and we use something similar all the time here, because I think we'll have this question like, do we need to invest more in our servicing infrastructure? And the answer is generally yes, but very often we go, well, the best servicing work you can do is better underwriting. Like, because if every loan that you have to go, pull into debt or call or catch up is generally a loan you maybe shouldn't have made, and the question is a little bit, how do we get better at servicing and dealing with those situations, but also a little bit like, how do we prevent them from happening in the upstream? And it's an easy one. It's an easy one to forget, but an
I
important
concur. Yes.
one. And then my last question is, what's one bold prediction for the future?
Yeah, I heard you ask one other guest this one, and but this can go a lot of places.
I ask everybody; they go all over the place. But sometimes I wrap up my favorite bold predictions. It's kind of a fun question.
Yeah, I guess for me, I'll say the credit cycle isn't broken and the interest rate cycle isn't broken. So we will continue to have ebbs and flows in those things. So I don't think interest rates are going to keep going straight up as they have the last several months. That they will probably kind of back off a bit for the maybe next few months or the rest of the year or whatnot. And we've had a fairly sanguine credit cycle during COVID with lots of government stimulus payments and so forth. So we'll probably have a little more of a significant credit cycle coming up the next time the economy slows, which is kind of showing a few signs of now. So I don't know how bold that is, but I would say those two cycles are still alive and well, and all the government stimulus didn't change them forever.
No, it kind of delayed some stuff, but it certainly, from a credit cycle point of view, has been an interesting couple of years to be new to the lending space, because we've seen a lot of different elements of the story play out over the last couple of years. So it's been interesting. But I think you're right; they're probably not fundamentally broken. Just we got to wait for them to make the full turn. Well, David, thanks so much again for joining us. I appreciate you making the time and sharing your perspectives with the audience.
Well, thank you. It's been fun for us. I don't know if it will be enjoyable for anyone to listen to or not, but I hope so.
Hey, if it's fun for us, I view that as the bar. I've not gone wrong with producing content that I think is interesting, my guests think is interesting, and then usually the audience follows along. And if not, at least we had a good time.
Awesome. I appreciate it. Thanks for talking to me.